This is not financial advice. Just saying. It's how to become your own bank. They call this infinite banking. A lot of people call it front loading. There's like a bunch of different names, but essentially it's all the same stuff. And so here's a couple of different things talking about the policy. So what we're talking about right now, just for some context and clarity, this is how to become your own bank, leveraging insurance. You see, the really cool thing about having insurance, if you pick the right one, you end up stacking cash credits in there. The idea basically behind this is you leverage your life insurance. So you take out a life insurance, they basically put it into two buckets every payment, right? If you get the right one. So you have two buckets: investment, and let's just say it's 0% to 8%. This is the actual policy. So every time you make a payment, what ends up happening is here's the money. Some of it goes to pay off the policy, and then the rest goes to investment. Whenever they do investment, this is what they call the floor, 0%. So it will never go under 0% your investment. This is called the ceiling, 8%. They invest your money into a portfolio or wherever it is, and they guarantee that it's not gonna go. You're not gonna lose any money because it doesn't go below 0%. They also guarantee that if they make 32% interest on the money that they invested, you're only gonna get 8%. Like I said, this is not financial advice. This is just to let you know how to leverage some of this other stuff that they don't really talk about. I feel like just in our community, nobody really talks about this kind of stuff. This is the monthly payment. So a piece of the payment, let's say it's $100, right? Let's say it's $100. That gets split up into two different buckets. So this pays off your policy. So let's say I don't really know exactly the numbers on how this, like how it gets split up, because everyone is different, but just to keep it simple, let's do 50-50. So $50 goes here, the other 50 goes into investments. The really cool thing about this is that later, after a certain amount, depending on what kind of policy you get, you can leverage it. So the one I'm specifically talking about, you got to just wait 30 days and you can take out some money. So let's say you've been doing this for a while, or let's say you put in a down payment like of 10 grand or something. Well, after you wait so many days, and every policy is different, right? But just for example, let's say you wait 30 days, and from the 30 days, let's say you can borrow the 10 grand back from it, right? Let's just actually use this in a scenario. So let's say you have $20,000 inside your life insurance investment deal where you can borrow against. You actually have cash value in there. So you have to have cash value in here in order to borrow from it, you know? So let's say you have cash value in there, it's $20,000. Let's say you're trying to buy a car. So essentially, normally you'd go and get a loan and from a bank, or a loan, you'd go to a car dealership. They run your credit up. Once they run your credit, sometimes through multiple lenders, they'll see how much money you qualify for or credit you qualify for. And they'll tell you, hey, you got this much. Let's say you got $20,000, you have A1 credit or whatever. You can pick any kind of car off the lot. Well, instead of going through all that stuff and getting from your credit, let's say you have the same amount of money you needed in your life insurance policy. So let's say the car costs 20,000 and you have it in here in the investment portfolio. What you want to do is you want to borrow from yourself, take it out of there, use that, use the 20K to buy the car, use the 20K to buy the car. What you'll do is, instead of paying the bank, you just pay yourself because this is a loan. It's not a withdrawal. You're not just taking the money out. So instead of, let's say, and the reason why this is different, like why would you want to do that? Well, it's because let's say off of the 20,000, you get like a 3% interest. Let's just say 3% interest on the 20,000. You're gonna pay the bank this extra money. Why not pay yourself? So you can do the exact same thing. You're gonna get the exact same deal you're gonna get with the bank, and put the 20 grand plus that. You can make monthly payments in payments back into the life insurance policy. And this is freaking amazing. There's so many different things you can do. For one, this is a loan. It's not a withdrawal. So uninterrupted compounding. So let's say you have 30,000 in the investment fund, right? And you take out 20, the 30,000 cash value still stays in there. So let's say something happens where, something happens to the policyholder. They end up passing away. Whatever money's left right here will just get paid out once they, cash out the policy. Now, like I said, this isn't financial advice. I just wanted to bring this to your attention because the only reason why I knew this is because I went to Dallas. I was working in Louisiana in 2014, and I went to Dallas trying to figure out. It was whenever Patrick Bet-David was there before he moved to Florida. But I actually learned this there while I was at that shop. Otherwise, I wouldn't have known about this. Because, you talk to insurance agents, and they're just wanting to give you whatever you ask for. And since we don't know about this stuff, a lot of them don't say nothing. So wealth building, making money in two places. Well, one of them is because depending on how much money you have here, instead of borrowing from the bank again, you can borrow and buy a rental property with it, fix and flip. You can do all kinds of stuff with it. There might be limitations to this depending on what kind of policy you have. Specifically, I think I'm talking about a whole life policy. That was what it was called when I looked into it. But don't quote me because this is not financial advice, right? So compounding, because the investment right here goes up 8%. And you can do the math on that, depending on how much money you have in here, you can actually do the math on that. The other thing is financing major purchases, such as a house, a car, anything you can imagine that you're going to borrow money for. You don't have to do that anymore if you actually have this option. Leverage the policy. What does that mean? So, whenever Elon bought Twitter, what he did, from what I understand, was he had a bunch of stocks inside Tesla. He leveraged the stocks. He borrowed against the stocks that he had, so he didn't even use his own money. He borrowed against the stocks that he had, bought Twitter, and then he ended up getting raising capital for it and just put the money back, ended up replacing it with other people's money. It was pretty cool. I know that went kind of fast. You can look it up. Not going to get into the weeds with that, but it's the same thing. Essentially, you can leverage the policy. So if you have so much money inside the policy, you can borrow from it. From what I understand, it's kind of like having money in the bank. You can borrow money and say, hey, I got 100,000 in this life insurance policy. I got cash value. I want to borrow against it. If something goes wrong, for sure, you can just take the money from the life insurance. So there's a bunch of different things you can do. Hope you like this video. If you have any questions, drop a comment. If you have any suggestions or if you need more clarity or something, let me know in the comment section. Hey, I seen it's about half of you guys watching these videos. Half of you guys ain't subscribed. So it would be pretty cool, not just for me or for the channel, but just in general for people who, if you like this content, subscribe and like this content, so that way YouTube can pick up the algorithm, and it can get put in front of other people who also like to talk about the stuff we talk about, because these conversations are kind of hard to come across. So there's some key advantages over traditional products when it comes to infinite banking, like 401ks. Liquidity control. You can access your money at any time without any penalties. You don't have to be waiting. You have to get permission when it comes to this. There's no age restriction either, like the 401k. They give you a penalty if you're not 59 and a half. Something to that extent, from the research that I did and from the people I've spoken with, to be straight up, the guys that I talked to that actually have this, they have everything in a trust. So it's kind of like one layer deep, well, a couple layers deeper than the conversation we're having today, So yeah, they actually got it tied to a trust. It's a whole different setup. But realistically the process is still the same. So it's pretty cool. There's a bunch of tax benefits. The cash value that grows inside is tax deferred. The loans are accessed tax free. Death benefits is paid. So basically, whenever the insurance policy is going to be, they got to use it when the person passed away. It's paid tax. It's tax free. So there's different types of setup that normally, you put in some money. I believe it's the IRAs. You put in some money, and if you don't put it in the right one, because there's the Roth IRA and there's like a regular IRA. If you don't put it in the right one of them they tax you before while you're putting the money in. The other one they don't tax you at all until you take the money out. So if you, let's say you put $1,000 in and they don't tax you on it, and let's say it stays in there forever, 30, 40 years, you get like $20,000. They tax you, instead of taxing you in the beginning on $1,000, they tax you on the end when you take out the money, the $20,000. Instead of getting taxed on $1,000 whenever you first put it in, so that way it can grow, they wait until you take out the money and they tax you on all the money you got in there. That's been compounding since it's like, you know what I mean? You didn't pay no tax on it. So there's a bunch of different things. And I will say this though, you have to be careful and you have to figure out who it is that you're running this play with, because there's a lot of people who don't know how to do these things. There's a bunch of life insurance agencies. This is not financial advice. Once again, I'm not a life insurance agency. I'm just saying these are like some of the things I wish I knew. You can actually leverage this and become your own bank. And be careful with the life insurance policies. Like you have to figure out which one is the best one for you, front end loading. That they all have different names. I was in Dallas when I learned about this stuff, but the first time I heard about it, which was after, like 4 or 5 years later, whenever it was called infinite banking, it was a guy out of Houston. He was actually, doing the insurance policies with the trust and all this stuff. So I learned this first in Dallas. There was a guy out there. He had got a life insurance policy. I want to say he had paid it off like about a little over a year. He was paying on it, and he had stopped paying it. A couple months later, like 3 months later, he passed away. Although he did stop paying it, this is the payment, the monthly payment, and this was the investment fund. The investment fund was actually, when that guy stopped paying it, the investment fund basically took over and was making the monthly payments for him. So I think the life insurance policy was like $250,000 or something like that. I'm not really too sure. It was six figures. I can't remember exactly how much. So because of this policy, they were able to bury him and stuff because the family didn't have any money. So this is where I first learned about that, was in Dallas. And then whenever I heard about it being in a trust, that was with Infinite Banking, a guy in Houston. Like I said, so you got to figure out who it is that is actually going to help you out. You got to look at the policies yourself. You got to figure out what's what. Don't take somebody's word for it and figure, like, you got to look into the policies. What's the policy called? Like, you have to do your research on it. We have the internet, you have AI, you have all kinds of stuff. You can look up this stuff, figure out what's what. But yeah, there's levels to this. This is one of them. The next level would be like, with the family trust. We're going to get into that a little bit later. Talk about trust and how we can utilize them. But thanks for tuning in. I appreciate every every view. And if you have something you want me to cover, drop a comment, let me know what's up, message me. Thanks a lot. Peace.